Good afternoon, folks, and welcome to a special ticker video update. Look, folks, this is a real serious matter. It's a beautiful day down here in sunny Florida, but we need to talk about something that's real serious, and that is what I believe is the potential intentional engineering of a bond market collapse undertaken by one Ben Bernanke. If you go back and listen to Senator Kennedy's and his exchange during their testimony, during the time that they were on the Hill related to the Bear Stearns bailout, buyout, whatever you want to call it, which, by the way, I've argued is illegal, you'll find that Mr. Kennedy and Mr. Bernanke engaged in a conversation that essentially was along the lines of, you do it, no, you do it, no, you do it, no, you do it, back and forth. Mr. Kennedy was trying to draw out Mr. Bernanke on whether or not Congress should enact additional protections for people who are being foreclosed and having their homes at risk of being lost. Ben refused to give him a straight answer and essentially kept throwing it back at him as, that's your job. Well, that's your job. Well, that's your job. Well, folks, here's the problem. We have $9 trillion in public debt right now on the balance sheet of the United States. The total damage in terms of lost value from this collapse is going to be approximately $10 trillion. To the extent that Congress attempts to monetize any significant part of that, there's a very real risk that the Treasury market will, in fact, undergo a collapse. Many people think the Great Depression happened because of the stock market crash in 1929. That's not true. What actually set off the Great Depression was a collapse in the bond market, which happened in 1931. The result of that was that borrowing became insanely expensive for everybody during an economic slowdown when people needed to be able to borrow to keep their heads above water. As a result, the second, third, and fourth legs down took place, and we had what turned into the Great Depression. That was what spiked unemployment. That was what caused the major part of the problems. It was also ultimately what sent a lot of banks over the edge and into insolvency. The problem here is that Bernanke and his friends are facing one of two possibilities. One is some sort of major hyperinflationary printing campaign where they end up with their money back for these debts. However, the money's not worth anything. That doesn't do them any good. Banks don't want to be in that situation. The other possibility is a deflationary credit collapse. And if that occurs, then people who owe things will actually default on that debt. They won't be able to make the payments because money will become more valuable because it is more scarce. In that circumstance, what ends up happening is the bank ends up taking your house. Now, they have the assets and they have all your money because, of course, you pay what you can before you go under. That's provoked, folks, by unrestrained, profligate government spending in an attempt to prop this thing up, and that's what's going on. The $30 billion that was committed for Bear Stearns, although it was illegal, was really a teaser. And during the Easter break, we found these people going out and actually trying to drum up support in their constituencies to find out what they wanted. And what the constituents kept telling them is, where's ours? Well, okay. Look, the first part of this, here's a bill that I have dug up, thanks to some people on the forum, filed on March 14th. Now, that predates the date of these hearings, but folks, it is approximately at the time when all this started. It is called Homeowners Loan Corporation for the 21st Century. It is linked underneath this, the thread that has this video. The important thing here to keep in mind, folks, is that it allows up to $300 billion to be put out there in the form of public debt, which will be backstopped by the Treasury. The obvious here is that it says originally that the interest shall be unconditionally guaranteed by the United States, but then the next paragraph very cutely says, in the event that the corporation is unable to pay the interest or principal, the Secretary of the Treasury shall pay to the corporation the amount of such interest or principal. Not may pay, but shall pay. Effectively, what this does is create a $300 billion debt upon the balance sheet of the United States. This is the start, folks. This is what I had predicted may happen. We have $2 trillion in real economic losses that are going to be taken in actual losses, and we have a $10 trillion diminution of value. I wrote about this in the ticker. This is very serious. You need to understand that if this kind of thing gains any sort of traction at all, the possibility of a bond market collapse is very real. I believe I cannot prove, but I believe that the intent of Mr. Bernanke's testimony and the intent of his line of response with Senator Kennedy was, in fact, to provoke that sort of response and that sort of collapse. I believe that his intent was to provoke Mr. Kennedy into putting forward additional legislation which would essentially obligate the United States Treasury far beyond what it has already spent. I believe his intent is to provoke exactly the kind of thing that happened in the 1930s. The reality of the situation is this, folks: the Fed does not set interest rates, the market does. If you take a look at a chart of the IRX, which is the 13-week T-bill rate, you will see that the IRX leads the Fed funds target both up and down. It always has done so. It always will do so. People believe the Fed sets interest rates because that's what the Fed wants you to believe. But those of us who trade the markets and those of us who have been in the capital markets know that that's false. You need to choose, people. You either need to stop this insanity and stop it now. We need to stop adding to the government balance sheet. We've added $165 billion already in the form of stimulus checks. Now they're proposing to add another $300 billion. That's $465 billion in direct bailout assistance to the American taxpayer. That's about a quarter of the $2 trillion in economic losses. What you need to understand is that when the credit markets react to this, when the bond market reacts to this, if this becomes reality, the possibility of a waterfall collapse in the bond market is very real. If that occurs, your borrowing costs will go sky high immediately, and economic activity will all but cease. We do not have time to fool around with this. Once these things become passed into law, they will be impossible to get rid of, and the bond market will react to them when it perceives that the probability of these laws being signed is high. I do not know exactly when that time will be, but what I do know is what the consequences will be, because we have a blueprint for that. Ben Bernanke has said many times that he will print money in order to prevent a deflationary event from occurring, but in point of fact, he's done exactly the opposite. He's been selling treasuries and draining currency out of the system for several months. This continues today. It is your choice, people. You can either sit back and listen to the people on television that tell you all is well because the stock market has gone up, or you can pay attention to what's really going on and what is going to occur. We are running the playbook from the 1929 to 1932 period almost exactly, except that we've compressed it a little bit in time. But the players, in many cases, even have the same names. It is your decision whether or not you're going to get off your tail and act on this. But if you want to stop this, you need to get on the phone to your Congress people, your representative and your senators, and you need to do it now. Once these laws are passed, or if they become a realistic chance of being passed, the opportunity to act in order to prevent this travesty will have expired. Please read the additional material that is attached at the bottom of this. Listen to Mr. Kennedy and Mr. Bernanke's exchange. You tell me if you see the same thing that I see, an attempt by the chairman of the Federal Reserve to goad Mr. Kennedy into taking an action that Mr. Bernanke knows will produce a given result, one that he wants and you do not. Have a good day.